Hey guys, how's it going? Recently we were given a project for Finance 381 where we were supposed to do a financial analysis of 3 companies. We were given one as a class and we had to choose 2 other ones. The one we were given as a class is Sanderson Farms. The second one I chose is Superior Energy Services. And the third is Hornbeck Offshore. Real quick, I'll give you kind of a description of each. Sanderson Farms Incorporated is a fully integrated poultry processing company engaged in the production, processing, marketing, and distribution of fresh and frozen chicken and other prepared food items. Superior Energy Services is oil and gas, a little bit different than Sanderson Farms. Superior Energy serves the drilling, completion, and production-related needs of oil and gas companies worldwide through a diversified portfolio of specialized oil field services and equipment that are used throughout the economic life cycle of oil and gas wells. And then Hornbeck is kind of oil and gas. They deal more with transportation. We're a leading provider of marine transportation services to exploration and production, oil field service, offshore construction, and military customers. Now, in this financial analysis, we were given 3 questions to look at or to go about answering. The first is, who would you make a short-term loan to? And with that short-term loan, it's going to be 6 months. And we are going to be looking at categories such as your quick ratio, cash ratio, and current ratio. We're going to kind of decide who we want to go with, judging by those ratios. The second one is, who do we make a long-term loan to? And that's going to be a 5-year period. And then the third is, whose equity are we going to buy? And for those, we're going to be looking at things like return on equity, return on assets, and PE ratio, and then market value and book value. Alright guys, now that I've kind of given you the basis for the project and the companies we've chosen, I'm going to lay out the short-term ratios real quick. We have 3: quick, current, and cash. We're going to take a look at current real quick. Current is your current assets over your current liabilities. As you can see here, current assets is cash, accounts receivable, stuff like bonds and stocks. Current liabilities is accounts payable and pretty much anything due within the next year. One of the companies I chose, as you can see here, is Superior Energy. I kind of just put their stock symbol. Their current ratio is 2.43. Most people will say, and I have to agree, this is a pretty good ratio. Pretty much all you have to worry about is if it's below 1. Or if it's above, let's say, 3.5, we'll say. It's not really a bad thing if it's too high. It's more of just kind of something to look for, because it means that, let's say maybe you have enough cash to invest in, let's say, another store. You have cash sitting there that you're not using. So that's going to make your ratio higher. So why not, invest that money in another store to help you generate more revenue? All right, guys. Next, in terms of short-term loans, we're taking a look at our cash ratio. This is different from current in the fact that it only takes into account cash versus all your current assets. So we're kind of narrowing it down to cash alone. Well, I mean, we're not kind of, we are. So it's cash over current liabilities, which we talked about earlier, which is kind of like your accounts payable and things you'll be, things that are due within the next year. As you can see here, I wrote down Superior Energy as an example. They have a rather low cash ratio of 0.55, which, as we can see here, means that they can only pay for 5.5% of their current liabilities. And pretty much this ratio is used to pay for your short-term debts. Lastly, for our short-term ratios, we have our quick ratio, which is current assets minus inventory over our current liabilities. The main reason we take out inventory is because we want to see how a company can pay for its liabilities without selling their inventory. Main reason is, let's say, inventory can kind of be unpredictable. It could sit there for a while, something could happen to it, natural disaster occurs, it gets stolen, it goes bad. So you don't want to have to rely on that. Something could happen to it. Pretty much the only thing to keep in mind, if it's below 1, pretty much like all our other ratios, it's a concern. As you can see here, Superior is somewhat close with the 1.85 quick ratio. For our assignment, we were told to pick 2 as far as a short-term loan. So we'll take a look at cash first. As you can see, Hornbeck has the best cash ratio as well as current and quick. So we're going to go with Hornbeck and Sanderson with our short-term loan, pretty much just because they have the best ratios, and pretty much all of these involve assets. So if we were to invest with them, we know that they're going to be able to pay us back in the short term.
Looking woman with her arms round me, here in a small town where it feels like home. I got everything I need and nothing that I don't. Oh no, oh no.
Alright guys, next we're going to talk about which company we're going to give our long-term loan to, which is a 5-year period. First, we're going to discuss the total debt ratio, which is total liabilities divided by total assets. Pretty much what this ratio talks about is how dependent are we on our leverage. So pretty much we do not want to be dependent on our leverage. So with that being said, a low percentage is good, while a high percentage is bad. So as I said before, we want to go with the lowest. So as far as total debt ratio, we'd have to go with Sanderson and Superior. Next, in terms of our long-term loan, we're going to look at our debt to equity ratio, which is total liabilities divided by stockholders' equity. Like it says here, along kind of like the total debt ratio, with our debt to equity, we want as low as possible. What that means is it's a strong equity position, and as far as a high percentage, it's vice versa. Bad, weak equity. So next we have our return on equity, which is our profits from our investments from our shareholders, and it's net income divided by stockholders' equity. The ideal range that we want to be in is anywhere from 15 to 30%. So with these results, as far as our long-term loan, which is the 5-year, we're going to give it to Sanderson Farms and Superior Energy.
'Cause I know I got some good friends that live down the street. Got a good...
So lastly, we were told to make a decision as to whose equity we wanted to buy. So we took into account price earnings ratio and return on assets. As you can see, the return on assets, if it's high, it's good, low, bad. And it's pretty much how profitable the company is relative to their assets and how well they use assets to generate earnings. Lastly, we have our price earnings ratio, which is the current market price divided by the earnings per share. And says it right here, it's pretty much how much are the investors willing to pay us per dollar of earnings. Sanderson has a really good return on assets as well as a low price per earnings. And then Superior has a good return on assets as well.
That live down the street, got a good-looking woman with her arms around me. Here in a small town where it feels like home, I got everything.